For years, corporate treasury management was viewed as a back-office function. Important, yes, but not exciting. Treasurers focused on cash balances, short-term investments, foreign exchange hedging, and ensuring payroll and debt payments were handled smoothly. It was about stability, not strategy. It was about safeguarding liquidity, not driving growth. But in 2026, that perception has changed dramatically. Corporate treasury is no longer just operational, it's strategic. And we're seeing a new boom in corporate treasury management because volatility, higher interest rates, and capital discipline have pushed cash strategy to the center of business decision-making. Let's start with interest rates. For more than a decade, rates were historically low. Holding excess cash generated minimal returns. Many companies prioritized deploying capital into growth, acquisitions, stock buybacks, or expansion projects because idle cash earned very little. That environment is gone. With interest rates elevated compared to the ultra-low-rate era, short-term investments are once again meaningful. Treasury teams are actively managing cash portfolios to generate yield. Money market funds, short-duration treasuries, commercial paper, these are no longer background tools. They're contributing real income. For large corporations with billions in liquidity, even small yield differences translate into substantial earnings impact. Suddenly, treasury decisions move the income statement. The second major driver is volatility, demand volatility, currency volatility, geopolitical risk, supply chain disruptions, energy price swings, market sentiment shifts. In uncertain environments, liquidity becomes power. Corporate boards now ask detailed questions about cash positioning, debt maturity schedules, credit exposure, and counterparty risk. Treasury teams are responsible for ensuring flexibility in multiple scenarios. Companies are lengthening debt maturities, staggering refinancing schedules, and maintaining larger liquidity buffers than in previous cycles. Why? Because access to capital is no longer assumed. In tighter financial conditions, raising debt or equity can be more expensive or less predictable. Treasury teams are focused on ensuring the company never has to refinance under pressure. That changes behavior. Instead of maximizing leverage, many firms are optimizing for resilience. Another reason for the treasury boom is the rise of centralized capital allocation. CFOs are consolidating decision-making authority. Instead of each division managing its own cash and funding strategy, corporate treasury increasingly operates as a centralized capital hub. This allows companies to allocate resources more efficiently. Surplus cash in one region can offset needs in another. Global liquidity pools can be optimized for tax efficiency and currency exposure. Technology plays a role here. Modern treasury management systems provide real-time visibility into global cash positions. Automation tools improve forecasting accuracy. AI-driven analytics enhance risk modeling. Treasury is becoming data-driven in a way it wasn't a decade ago. There's also a debt management transformation underway. During the low-rate era, many companies issued long-term debt at attractive fixed rates. Now, as maturities approach, treasury teams must decide whether to refinance, retire debt, or adjust capital structures. Higher refinancing costs force strategic trade-offs. Should the company preserve cash? Should it reduce leverage? Should it adjust dividend policies? Should it delay capital expenditures? Treasury is deeply involved in those conversations. Foreign exchange exposure is another major factor. Global companies operate across multiple currencies. With geopolitical uncertainty and shifting monetary policies, currency swings can meaningfully impact earnings. Treasury teams are expanding hedging programs and stress testing currency risk. This is not just about smoothing earnings, it's about protecting margins and cash flow predictability. Predictability in today's market commands a premium. There's also growing emphasis on counterparty risk management. Recent years have reminded corporations that financial institutions can face stress. Treasury teams are diversifying banking relationships, reviewing deposit concentrations, and carefully managing exposure to financial intermediaries. Liquidity is no longer just about how much cash you have. It's about where it sits and how quickly it can be accessed. Another driver of the Treasury boom is strategic patience. When capital is more expensive, every investment must justify itself more rigorously. Treasury teams evaluate cash timing alongside return projections. A project may have strong long-term ROI, but if it compresses liquidity in the near term, it may be delayed. This shift places Treasury at the center of capital allocation strategy. Cash timing often overrides theoretical return metrics. Additionally, corporate Treasury is increasingly involved in sustainability financing. Green bonds, sustainability-linked loans, and ESG-aligned credit facilities require Treasury coordination. Companies that tie financing terms to emissions targets or sustainability metrics need Treasury teams that understand both capital markets and regulatory frameworks. That complexity adds another layer of strategic importance. Private companies are experiencing similar trends. Family-owned businesses and private equity-backed firms are investing more in professional Treasury capabilities. With borrowing costs higher and lenders more selective, maintaining strong liquidity profiles improves negotiating power. Treasury discipline strengthens credit relationships. Even technology companies, traditionally growth-focused and capital-intensive, are emphasizing cash flow management more than in prior cycles. After periods of aggressive expansion, many firms are recalibrating toward free cash flow generation and balance sheet strength. Treasury teams are leading that recalibration. The cultural perception of Treasury is shifting too. What was once seen as a conservative function is now viewed as forward-looking risk management. Executives recognize that in volatile markets, survival and optionality depend on liquidity strategy, and optionality is valuable. Companies with strong Treasury management can move quickly when opportunities arise. They can acquire assets during downturns. They can invest in innovation without relying on uncertain capital markets. They can weather demand slowdowns without reactive restructuring. That confidence flows from disciplined liquidity planning. Another important factor is investor scrutiny. Markets are paying closer attention to free cash flow, debt levels, and liquidity coverage. Earnings alone are not enough. Investors want to see durability. Treasury decisions influence that perception directly. A well-structured balance sheet supports valuation stability. Transparent capital allocation builds credibility. Strong liquidity reduces downside risk. As a result, Treasury is now central to investor relations messaging. In many ways, this boom in corporate Treasury management reflects a broader shift in business philosophy. For years, growth dominated the narrative. Now, resilience, flexibility, and predictability share equal weight. Cash is no longer idle, it is strategic ammunition. Debt is no longer cheap leverage, it is a carefully calibrated risk. Liquidity is no longer assumed, it is engineered. Corporate Treasury has moved from the background to the center of strategy. Because in a world defined by uncertainty, the companies that control their cash, manage their risk, and protect their balance sheets are the ones with the most freedom to act. And that freedom, more than any short-term metric, is becoming the true competitive advantage.